the unknowns, the anxiety of clients, from financial markets to real estate, everywhere. I mean, it's a very volatile time and definitely a lot of questions coming up.
This is Laricy Live, and I'm your host, Matt Laricy, giving you unfiltered access to the world of real estate. We cover market trends, news, and give you the honest answers that will keep you ahead of the real estate game. Laricy Live is brought to you by Zenlist. Do you want to know the secret to growing a high-volume real estate business? It's not just about generating the most leads. The key to success for Laricy's agents is providing the best client experience. We put our clients on Zenlist because we know that they're getting the modern, mobile experience they not only want, but expect from their agent in this day and age. Using Zenlist with our clients put us all together in a shared space where we could work together during the home search process, which helps us be efficient and provides our clients the VIP treatment. Sign up for Zenlist using code Laricy Live, no spaces, all lowercase, to save $240 on your first year's subscription. Laricy Live is also brought to you by Lincoln Title. Lincoln Title is the best and most efficient title company in Chicago and the best place to close your property. Today, we are here with a special guest, Paul Tokarz, with Westpoint Financial. Paul, how are we doing today?
Doing great, Matt.
Did I get the name right here this time, right?
You did,
I messed it up
yes.
here for a second. And the reason we brought Paul on is that, we're heading into tax season. We're heading into like prime time season here. We kind of got a lot of things going on that have to do with money, right? And as a guy that works a lot with money, I'm assuming you're decently qualified to understand how it works, right?
Yeah.
And we thought we'd bring specials on because we have a lot of people out there. We have, young first-time buyers are wondering about like what to do with down payments. We have high-end luxury buyers that are wondering like, is now a good time to buy into a bigger property. We have, people looking at vacation homes, second homes, etc. We thought, hey, let's bring somebody else in that may know, one or two things more than we do. Paul, how long have you been working in finance for?
Over 10 years, and I would say you're right. I mean, this is a time period right now in my career where, the unknowns, the anxiety of clients, from financial markets to real estate, everywhere. I mean, it's a very volatile time and definitely a lot of questions coming up.
Yeah, nobody can really kind of predict. Every time I talk to somebody, they're like, I know rates are going to go down and they go up 1%, or somebody's like, the bond market's going to keep dropping and then it goes up, right? So, there's just, and listen, if everybody could predict this stuff, guys, like we would all be sitting on yachts drinking champagne. We
would not be working.
Sometimes I feel like when you hear those things, do you ever get one of those random text messages when it's like, hey, I got the best picks for the college, games. And it's like, it's just some random like gambling almost. And that's kind of like how the markets are. But this is why it's important here. Like, hey, let's look at some facts. And then everything's all, pretty much a calculated risk. Okay. And when we're talking about the volatility of the marketplace and interest rates, like how are clients kind of like, what are you telling your clients that are coming to you and like, hey, I'm thinking about buying a place? Like what's your best piece of advice that you're kind of trying to tell people right now?
I mean, I think what we do best is we take a step back, and I don't care if you're a financial advisor to any firm. I think the best advisors take a step back and try to understand the client and understand their budget.
Yeah.
Understand, hey, before we start talking to a mortgage broker or to a realtor, where do you want to live? What neighborhoods? How much cash do you have in the bank? How much money do you want to put down? It's really just understanding a lot of these different variables and educating them on what reality is.
Right.
And then teeing them up with the best realtors we can, best mortgage brokers we can to make sure that they understand what that process looks like. But before we kind of push them in that direction, we do want them to understand how much should they be trying to afford based upon their budget and based upon how much cash they have.
So when you're talking about affordability, like have you had a lot of like your people come to you and ask you like, do they think rates affect the market? And like, are they been nervous about rates for you? Because rates have been like, it's been our hot topic this year. They're up, they're down. They went back up again. Who knows what will it be by the time this comes out? But is that a big topic with you and your clients?
100%. I mean, interest rates going up this fast, this quickly in our lifetime, I don't think it's ever happened as fast as they've gone up. And so, we look at a year ago where rates were to today, and it's a whole different world, right?
Yeah.
So it is 100% a topic of conversation. I even speak with my developer clients who are a little bit nervous on their projects and what the future of those projects look like, just because, are there going to be less buyers, there's going to be less competition. And so 100%, it's definitely probably the most important topic, whether it's regarding real estate or even domestic equities and bonds.
Yeah. I mean, and I think probably, I'm assuming this is a question that kind of comes up, is just the fact that like Chicago home value prices compared to, let's say, Florida have not like really gone up that much, right? I mean, and you guys work in a few different states. Do any of your people ask you about like, well, hey, like what's the, financial kind of, is it smart financially for me to invest here rather than in different states due to the, appreciation rates in different places?
So I would say one of the oddest topics to understand is this, and again, you guys are the experts when it comes to real estate, but it's been really, really hard to understand the Chicago marketplace versus the news of what's going on in Florida, Phoenix, Texas.
Yeah.
You have all these states that during the peak were doubling, tripling in value, and then all of a sudden they've come down 15, 20, 30% from the all-time highs, where Chicago didn't have that double, triple increase on real estate. And so you don't see such a reduction. And again, with lack of inventory, you're not seeing that much pricing reduction. However, the clients only read the news and they see all the articles that are out there. And so there's a lot of times, hey, Paul, why hasn't Chicago had these drops on the real estate side? And again, I'm not the real estate expert. I don't know those exact answers, but it's more of like, we didn't have that growth, and we didn't have, so that reduction is less.
Yeah, I mean, financial advisors in Florida drive me crazy because they're advising their clients not to buy because they think they're going to drop more. I'm like, well, you guys in Florida, I mean, the reality is Chicago's always been like a slow and steady growth. We're like a turtle, like an annuity, right? 1% to 2% a year. Even during heck, I saw a lot in River North and Gold Coast, our prices went down 20% the last 3 years, right? So when people are like, we think the properties are going to drop like 20%, I'm like, okay, so we're going to be down 40% since 2019. Doesn't make sense. The red states won during the pandemic. I don't care about politically where you stand, but that's just the reality of life, is that a lot of people panic bought, right? People in Chicago are like, I'm sick of the politics. I'm sick of the crime. I'm sick of the protests. I'm getting out of here. They moved to Texas, Florida, Utah, Idaho. These places saw 300% growth. And now what's happening to these people is they're saying like, hey, sitting around in Texas talking about water all day, because they talk about water like we talk about the weather, they're getting sick of it. And they're like, hey, I don't like Chicago that much, but I'm sick of driving everywhere. I want to get back to the city. So we're seeing a lot of people come back that went to these, other states that are now, that's why they're seeing these drops and we're not. But the problem is we deal with a lot of financial guys in other states that don't know what's happening in Chicago, so it's been like a big problem for us. What are you telling clients who see big swings though like that? Like, are you telling them that like, we're normally not as big as there, or is like, what's the best advice you could give to those guys?
Define that question a little bit more. What do you mean?
So like if somebody's coming from Florida, like, hey, my real estate prices just dropped 20%. I want to move to Chicago. Like, what do I do? Like, right? Do you think it's going to drop 20%? Rates are high. The market's about to crash. The bond market, who knows what's happening here? Like.
For us, it's making sure that they're just educated, right? Again, because as I mentioned before, the news is the news, the articles are the articles, and they need to be very specific on what they're reading in Chicago, right? I mean, for me, every single day I'm reading Crane Chicago, I'm reading Wall Street Journal for national news, but I have to have a pulse of what's going on in the city. So what I'm trying to tell our clients, regardless of whether you live in Chicago or someone that's moving to Chicago, is regardless of what's going on in other real estate markets, you need to understand what's going on in Chicago specific, or any other territory or city you're going to, because every single city and state is different and dynamic.
It's very local, right?
Right.
There's a lot of, we could look at the macro trends of what's happening, but I talk about this all the time. Like the macro and the micro don't really make, it doesn't really matter if everything's very local. What's happening in Hinsdale and Western Springs, we were talking about this before the podcast, already lives in the western suburbs. I'm like, it's totally different than what's happening in River North,
Right.
And we're in the same state. It took you, 30 minutes to get down here? 45?
Metro train, 26 minutes.
26 minutes,
Express.
So like it's a quick thing. So, it's a 26-minute train ride for almost going to a different country and markets,
Right.
When do you think you would tell somebody to start talking to you before thinking about making a purchase?
So, man, I think that's a great question, because what I always get nervous about is finding out after the fact. I mean, obviously, we're doing our best to have our reviews with our clients all the time. And obviously, when we pick up new clients, our hope is that they're coming to us before these big purchases, because what happens is after the purchase, there's not many things we can fix, right? When you're pot committed to a real estate purchase, which is arguably probably the biggest investment someone makes in their life on a person.
I would say so.
Right. And so when we catch them after, it's very difficult to fix. When we catch them before, I always say, listen, if your goals, again, very dynamic market, but if your goal is to move this year, right, we should be talking now, and we should make sure that your finances are lined up correctly, so that you're not going to be house poor. You're not going to be in a position where 6 months or 12 months from today, you're
What's your definition of house poor though? Because I use that all the time. Like, you want to be house poor, but like, is there like a financial lingo of like what people would say? Like, do you want to spend 20% of your wealth on housing, 50, 60, 10?
Without getting so specific on it, what I would say house poor to me would be in that you're making significant sacrifices to your decision making in your household, right? So if I'm, and again, that is such a relative term for many different people, but if my standard of living is deeply impacted, and again, that's a very relative term, but if I have to really shift, what I'm spending for my kids, if I'm going on vacations, if I am going out to eat, I'm not saying that you're house poor, but you're making extreme sacrifices for that real estate purchase. And for some people, Matt, they may want to do that, and for some people, they may not want to do that. So every specific situation is different. It's hard to say for sure what does house poor mean, because everyone looks at that as a different term.
I mean, we see a lot of clients, they overextend themselves all the time. Honestly, specifically, it's my guys in the medical field, right? So I have this theory that they're used to taking on debt, right? They take out medical debt, right? And then they take out, like, they give them these no money down loans, so they're used to it. And I always tell my clients all the time, like, listen, if we're stressing ourselves here, like, no, you should be able to go on vacation. They're like, get the extra couple gallons of milk at the groceries, or those eggs nowadays, which are really expensive, But I do think it's important for people to talk to their financial persons, because, like, I could tell you where I think it's going to go and what's happened in the marketplace, but I don't know what's best with your cash. Right. You know what I mean? Like, it's something that you have to talk about. But I do think if you can't go out to dinner, you have to sacrifice a couple vacations a year. Well, maybe a couple of vacations is too many, but like one vacation a year or something like that to be able to enjoy life, it may not be the best decision. Is there a difference on like how you advise people that are single versus married?
I would say so. I mean, when I think, I even think about my own situation, right? When I was single, buying any piece of property,
bachelor pad, sick, leather couches.
It had nothing to do though with the neighborhood, the safety, the schools, right? It was more of where could I be in a place that's socially fun and I could get to work relatively easy. Yeah. So a single person to me is not, again, looking at the key elements of schools and safety. I think once you're married and you have kids, it's a whole different ballgame, right? I mean, even for myself, it was where can I wake up every day and make sure that my wife could be with the kids and I don't have to be stressed out about it, right? And so I think the mind shift changes a little bit on that. And the questions we ask our clients about, again, how many bedrooms do you want? What type of school district do you want? Are you going to go private? Are you going to go public? It just becomes way different questions for that type of client versus the single person who doesn't care about any of that stuff.
Do you factor in wine storage at all into these conversations at all? Paul's a fellow wine snob as well. So for people out there know that I have quite the wine problem. But I mean, these are questions you got to ask sometimes. Right. This might be maybe a single guy, but married people might want to get into it. But I mean, is there a difference in like the way these guys like file? Like if it's single versus married, like is there any benefit on like a write-off or a financial decision either way, or is it more just like lifestyle?
When it comes to write-offs, I mean, again, I think the best financial advisors are really kind of leaning towards the tax experts on making sure they're getting that stuff right. I mean, it's going to be hard for me to say exactly what someone needs to do on a tax perspective, but just making sure that they have the best accountant they possibly can to handle that.
I'm a typical American. I love America, but I don't want to pay any taxes for it, but we have to, right? That's the general mindset. So anytime I can ask a tax-related question somebody may want to know about, I want to know how I could get out of it.
Matt, I tell my accountant who may see this, hey, if this is the line, take me to the line and don't cross it. Yeah.
I mean, I think most people are that way. What about people who are looking to buy and sell, and they're like, hey, I can afford to do it, right? Like this is a big one we hear all the time is like, I want to buy and sell, and as agents, like I always say, like ideally speaking, you buy and then you move out and then we can sell your place because it's just easier, right? But just because it's easier, I always say like financially, it may not make the most sense for you. So I asked my clients this. I said, what's more important to you? Is money more important or is time, right? Because I have a lot of clients who are super wealthy and like time is way more important than money. They have more money than they know what to do with, but they don't have any time. So in that point, you buy and sell. But there's a lot of people, which would be like 99% of people that I know, finance and money is more important. What do you advise people who ask that if they could float it? Like, do you look at their numbers or how do you determine like what's the best move?
Yeah, I mean, Matt, you're right? So the ultra high net worth clients are not going to be concerned on that ever, or really on a lot of things, right? Because they have the cash to float whatever they need to float. Right. The average, mom and pop type client, very concerned about buying and selling in the same year because there's going to be the cost of, well, what if the closing date doesn't perfectly align with the next date of closing on buying, and very rarely do they ever do, right? I mean, it's hard to time that perfectly, right?
There's always something that happens.
Always something, right? So you're looking at short-term rentals. Am I moving in with my parents? Where am I going to put? Am I paying for storage of all my stuff? I remember when I moved to a condo in Andersonville. I mean, I had to pay, I want to say, a month of storage for all my stuff. You know, so I think those are things that you have to educate, or we have to educate our clients on, saying, hey, listen, if you buy and sell, very rarely is the timing going to be absolutely perfect, and you should be prepared to understand, is there a short-term rental need? Do I need to move in with my parents? Am I going to pay storage costs? There are additional costs above and beyond that they just need to understand.
With buy and sell, you know, and then kind of pivoting that into like more like 1031s. Do you ever get involved with 1031s at all with your clients?
Yeah, I mean, our clients do them. Yeah. Obviously, we're not the person who's overseeing that transaction, or
most aren't, but
right. So yeah, I mean, we understand them. We understand on the investment properties that that's a process that a lot of people want to do because they want to delay that taxable gain.
Getting back to taxes, that's all.
Yeah, getting back to delaying that taxable gain. So it can be a strategic move for a lot of the investment properties. Yes.
So, you know, talking about investment properties, there's this thing called inflation right now. It's a little high, right? We talked about this earlier before this. I was like, man, you know, it's spring release for wine clubs. I was mad because like a lot of prices went up, and he said inflation. Like, you know, I feel like inflation is just one of those things right now that everybody's just kind of using.
It's an excuse for everything.
It's just an excuse. Like if you're like, hey, this is normally $5 to water, like, it's $6 for inflation. You're like, yeah, whatever, it's an extra buck. Inflation.
What's your parking tickets now?
Yeah, they're $70 now. They used to be like 60. You know, so. But you know, when you talk about inflation and kind of a volatile stock market, I mean, like, you know. Real estate's always been like a good way to park cash, right? Because it protects your money against inflation, you know, diversifies your assets. You get another, I always say, you get another vehicle on the ground to gain wealth, right? What are you guys telling clients who are thinking about like, hey, I want to, you know, start parking some money in real estate? Is that something you guys advise on, or do you tell people not to, or what do you go about?
Great question, right? So obviously we get questions all the time about real estate investments, whether it's a primary home, because sometimes people look at that as an investment, which I always say, primary residence sometimes should not be looked at as an investment because you're living there, but even on rental properties, et cetera. So we get that question a lot. What I would say, Matt, and this would be kind of generally speaking, I'm a huge fan of just diversifying always, right? So I don't care if it's a stock, it's a bond, it's a rental property, it's insurance vehicles, it's whatever, an LLC, separate business. The more areas you can diversify money, the better off you're probably going to be long term, because if one of those avenues blow up, you still have 4 other places you can get money from, right? So real estate for sure is another bucket where people can put money in, and we have a lot of clients that absolutely put money in there. Now, when they ask us our opinion on that, it's more of, again, we're going to you guys as the experts asking, hey, does this make sense from you know, cap rate? Is this where they should be? You know, again, we're not the person that's analyzing the deals. We can help oversee and give them a little bit of advice of, hey, this might not make sense. But
then what do you say then? Because most properties in Chicago, let's just, and because we get a lot of people out there, specifically younger guys that fall into a lot of money. They did like really well in the trading markets. They got a bunch of extra cash and they want to invest in it. And they're expecting like a 10 to 12% return, like you've been seeing in the tech stock market lately, right? You get those tech stocks, and it's $300 for Tesla. Now it's $1,000. Now it's down to like $150, right? You know, they get these highs and lows. But when you invest in real estate, specifically like condos, you know, if we looked at like a cap rate, you know, or like an ROI, you know, return on investment here, you know, you're looking at like maybe a negative 2% to a positive 2%, depending on what your rate is and what you're putting down, right? So let's say you're looking at a negative 2%, so you're losing a couple $100 a month. And would you say, like, to that person, would you say that's worth doing, or like how do you justify somebody taking negative cash flow on a property?
I think in an ideal world, you want to be positive, obviously, right? I mean, you want to find deals that are giving you some positive cash flow. What I always typically recommend to clients is, listen, whenever you get an investment property, you know, obviously it's a huge win when the property is paying its mortgage by itself, right? You have
mortgage taxes, assessments,
exactly, right? When it's covering the nut of the overall bills of the property, that's a win because you're getting free equity, right? Above and beyond that, net cash flow is always a huge positive because now you have extra money that you can, you know, do whatever you want with. When it's negative, honestly, I would just tell the person, like, you got to really analyze that deal, and are you okay with negative cash flow? Does it make sense for you? Is that something that you want, or does it make sense to look at a different deal? Again, every client's different. Some could have the appetite for being negative. Some cannot. It's more of making sure they understand that, hey, this is negative for now. Maybe rents will go up and maybe it'll be a positive at some point. do you for sure want to be at this property in this location? There's a lot of different variables, right? It just depends on what that person wants.
Yeah, the biggest problem right now, and for people out there thinking about investing, is that like, it's tough to be positive cash flow with rates are at like 8.25. Because a lot of people don't understand that if a rate is 6.75, if you're getting a condo, usually the rate's a little bit higher, okay? Because rates for single families and condos are a little bit different. And then if it's an investment property, it could be as much as 1 to 1.5% higher. So like, if you got an 8% rate and you're putting down 25%, like it's almost impossible to break even. So I tell people, it's like, listen, like if the rates go down to 5%, you refinance, now you're cash flow positive. But like, if you want, I always picture real estate as like a vehicle. So you got all these cars on the road, right? So kind of like you said, if one goes down, one falls backwards, hopefully the other one's picking it up, right? So, and it's creating me to have some more money. So if you're buying into one of these properties, you got negative cash flow today, how long can you go to you can either pay off that property, right? Because if it's completely paid off and now that rate goes away, it's just bringing down, now you're making $700 a month, right? That's great. Or you're solely depending on rates. Or what's your appetite to hold this for, right? Because we get a lot of people like, hey, I want to buy an investment property for 3 years, take a negative cash flow 3 years, and then sell it. And I'm like, well, this doesn't make any sense because then you have to pay commissions, and you have closing costs, and you're taking a loss every month.
And you have to get super lucky in 3 years.
Right. That you hope that the market in a normal Chicago real estate market, as we discussed earlier, goes up about 1 to 3%. So there's really no money to be made.
Right.
But like you have got, because I have people daily come to me with these questions. And I'm like, listen, I don't know. Man, it's not a good idea.
Well, here's the thing, right? You brought up an interesting point on interest rates. And what I'll talk, generally speaking, on interest rates, and I had a partner just recently buy a second home lake house. And we were discussing, I said, hey, is this the right time, for this interest rate? And he made a fantastic comment to me. He's like, Paul, at the end of the day, rates will either stay the same, and it is what it is. Rates will go down, and I'll refinance.
Right.
Or rates will go up, and I'll be happy.
Right.
So when you actually look at it, those three, because that's the only three things that can happen, right? So at the end of the day, it's like, listen, you're going to make certain investments for your family. You're going to make certain investments for investments. As long as you're happy, you understand how interest rates work and the options you have, you should be okay. Now, if you're forcing, not when I say you, but like if the situation itself is forcing a sale for no other reason for someone to say, hey, in 3 years, I'm going to flip this and make $100,000, that's just not the most educated decision, I would say, right? So you just have to be realistic on what your expectations are to make the best decision you can.
I agree with you when you say on rates. So like I could care less what the rate is because no matter what happens, I'll take the shortest term rate, the 5-year rate arm if it's a little bit lower, and I'll just decide 5 years from now what to do. Man,
it's very
things change.
And it's very similar to the equity market, right? People are always like, hey, when's the perfect time to get in? I don't know. We don't have a crystal ball. Right. It's like I do know this. If you never get in, the likelihood of money compounding long term is going to be slower, right? So it's just like interest rates. There's never a perfect time to get into the interest rate game. You might have gotten lucky and locked into 3%, but the reality is today, that's not the market today.
Well, I think the main thing to know about when you talk about low interest rates, or like with anything with finances, like just don't sell low. And like, at some point, like it'll turn back. Like it never stays low forever. Right. Rates never stay low or stay high forever. Just like, try to time it as well as you can, know. And you mentioned second homes. You mentioned your partner bought a second home. Second properties are starting to become a big time comeback here. Okay, so we get a lot of people who do one of two things. One, they live in like Hinsdale area or North Shore. Their kids are off to college and they want to get a second place downtown. Okay, because like they want to like kind of have the life again because the last 20 years of life they've been stuck with kids. We both have little kids. We're in that early phases of it. But like you're stuck with the kids. And the second part of those people are people who are like live in like these other states that have nothing that goes on in life other than cornfields, like Ohio, Iowa, Wisconsin, and they want places downtown Chicago. So like, what are you telling people who call you up and like, hey, I'm thinking about getting a second place like in the city? Like, is this financially a smart move?
I will say, if I'm being absolutely realistic, my phone isn't ringing off the hook on people that are trying to buy second places in downtown Chicago at this exact moment.
It's gonna turn. It's gonna turn.
But again, Matt, to me, it's not a question. Is my second home in downtown Chicago? To me, the location's irrelevant, right? As a financial advisor, I don't care where you buy your second home.
Right.
I care that one, it's a location that you want to be at.
Right.
The numbers make sense for you and your family.
Right.
And if Chicago downtown is that exact location you want to be, just understand the reality of what the Chicago market is and what's the purpose for this second location. Is it an investment property? Is it for my family on the weekends? Is it because I want to be here for the summers? All great reasons. They just need to understand what is the reality of why they're making decisions. Because to your point earlier, there's so many, I think there's so many buyers and sellers that are just unrealistic in today's marketplace because of the news everywhere.
Yeah.
It's just, you got to know where you're buying.
Yeah. I think financially speaking, most second properties make zero sense. And I'm in real estate. But I'll tell you, like, at the end of the day, on a financially speaking, like, we can deal with a lot of people who buy, like, second homes, right? They're usually older people who want a place in the city, right? And, like, financially speaking, could you just get, like, a kick-ass, like, penthouse in a hotel for the weekend you come in, a couple times a year for the same cost? You probably can. But I think people like to have a home. And I also think, at the end of the day, like, you only live your life once. Like, I don't know anybody that's lived twice.
Right.
And, like, you got to do what you want. Some people just want it. I think some people, it makes them feel better about themselves. Like, we sit around and, like, I got a place in Chicago. I got a place in California. And, like, you're semi-impressed and kind of makes you feel good. I hate to put it that way, but I think it is. And I think sometimes it's not all just about how much money you got in your bank to see it. It's also about, like, what do you want in life, right? So if somebody's in that position, do you think that's, like, completely dumb? Because I think that's most people's position who buy second homes. Or is it just like, hey, if you got enough cash on hand, you can't die with it, like, do whatever you want?
I mean, I've learned super quick in my industry. I mean, I can't judge that, right? So, like, for me as an advisor, I want my clients to be happy. If they want to buy a second place for whatever reason they want to buy it and it makes financial sense, more power to you. Where I get concerned in my position is if they're doing that second purchase and they're extremely stretching themselves. That's where I come in and say, hey, are you sure you want to do this?
Yeah.
Because this is the impacts. If you do this, this is going to impact X, Y, Z.
Right.
So, again, my conversation is very, very different in terms of judging what they're trying to do other than understanding what they're trying to do.
Yeah. Yeah. And I think I try to just lay it out to people, like, realistically, is that, like, if you want it, you want it,
Right.
Like, and that's it. Like, I can't financially, I don't look at your bank account.
Man, if someone has millions of dollars in their account, it's one of my clients is like, hey, Paul, I'm going to buy this regardless of what you say. What am I going to tell them?
Yeah.
Don't buy it.
Yeah. They'll find a different financial advisor, Like, and speaking of that, like, and you're talking about, like, people having millions in the bank and things, like, what is wealthy, right? Like, I hear this terminology all the time. Somebody's like, hey, I'm wealthy and I'm rich. What's the difference between the two? Like, how do you know you're wealthy? Like, what's the number you got to have in your bank account where somebody could be like, I'm good?
It's probably whatever's in your bank account. That's what I would define as wealthy.
No. But I mean, is there a certain number where, like, you're like, if you get to this, you could coast, like,
So, man, again, in my game, in my occupation, it's everyone's definition of wealth and rich is different. And so for me, as long as someone's happy and they can pay their bills and they can save, they can define themselves as
define
healthy.
Happiness.
You want me to define happiness? In my opinion, it's having options.
Yeah.
When you have options in life, I think you're pretty happy. When you have lack of options, I think it's not.
So speaking about the wealth predictions and what it means, like, what percentage of somebody's like overall net worth should be in real estate? Is there a general rule of thumb that advisors all buy to? Like, they all say 20% or 50% or whatever it is?
No, and I'll tell you why there's no simple answer to this, because my heavy real estate clients will be almost all real estate and they'll be levered like 3 times, right? And so those people make me a little bit more nervous, but their appetite for risk is so much higher than average people, right? So everyone's different. There's no right answer. Hey, what exactly should I have in real estate? It depends on someone's appetite for risk, making sure they understand the position, and that's it. I mean, the way that we coach our clients is more, hey, make sure you're saving 15 to 20% for retirement. Make sure you have your 3 to 6 months of cash reserves in the bank that equal your bills. You have those 2 things kind of set up, and you're taking care of your family on a monthly budget standpoint. How you choose to allocate your investment dollars after that is more of like, what gets you excited? Yeah. Right. I've seen a podcast before. Your excitement gets around bonds.
Yeah. Yeah. That's right. Very low return, slow and steady. Here's the thing. Like, when you talk about risk, like, I like to be negative risk. Like, I always tell, like, my advisors and people get mad about this, but, like, I just want to lose any money. I really don't care if I gain any money off my money. I don't want to see my money go down. I don't care if it goes up. I just don't want to see it go down.
The scariest thing last year, though, Matt, for the marketplace, so now I'm just strictly talking about 2022, right? Yeah. In our lifetime, the most volatile time period, and the reason I say that is because you and I are used to real estate going up and down. We're used to equity markets going up and down. Yeah. we have never in our life and in the history of the bond market seen bonds go down 13 to 15%. That's never happened. Now, again, you only realize those losses if you sold those positions.
Right.
But on paper, people that are super conservative, my older clients, they saw significant losses in bonds.
Yeah.
And no one's seen that. And because interest rates went up so fast, existing bond values went down.
Yeah.
And so last year was such an anomaly where it doesn't matter where you had your money. I mean, unless you were with Citadel Hedge Fund, you had billions of dollars. I mean, you lost money. I mean, it was tough.
Yeah, I mean, like in those scenarios, I was just like, I'm not selling today, so what do I care?
Correct.
But like, do people like, because I know like I'm a younger guy, we're doing okay in life, and like they want us to take as much risk as possible. They're like, throw it all in the ring, like, and I'm more or less like, I just don't want to lose it. Now I get it, like there's gonna be scenarios where you're gonna lose 13 to 15%, right? Yep. But like, those are one-offs, right? When you say you never saw it in life, right? And it's already starting to come back. It's not back yet, but in the next 24 months, it probably will be, okay? But like the point is like, do you advise younger clients that are buying homes to be more risky on their home purchases than older people? It's a good question.
Yeah, it's a great question. I mean, you're almost asking like now on the age side. I mean, I think when you're younger, organically speaking, you are probably more open to risk.
Yeah.
And the whole reason, Matt, is because of time, right?
Yeah.
You have time on your side to absorb the risk. When you're older, you have way less time, right? So that, to me, that's just a timing of, how long can I be exposed to that risk? I think when you're older, you got to be a little bit careful. I mean, how much debt do you want to carry when you're 50, 60 years old? How much mortgage risk do you want? I mean, who's going to pay off this debt if I pass away? I mean, there's a lot of...
See, this is where I disagree with every advisor we've ever talked to, okay? And I think you should be more conservative when you're younger and very risky when you're older. Because still to this day, nobody's lived their life twice. And like, if I'm 60 and I'm flush with cash, I'm fucking spending all of it. Like, that's it. That's when I can just enjoy everything I did.
But what I would say, Matt, is when you're 20, 30, 40 years old, if let's just say, for instance...
Those are your high earning years.
Well, hypothetically speaking, during your high earning years,
yeah.
if you do take 100% equity risk in the market, this is hypothetical.
Yeah.
The chances of compounding, if we look at the history of the markets, are relatively high, right? And so, not saying it's guaranteed, it's relatively high. The chances of being super conservative when you're younger and having the ability to compound growth is going to be lower. So it's just a matter. It's not of which one's better.
I just look at it like if you're at the top and you got it and you got enough reserves for whatever, now you can enjoy it and you have no worry about risk because you got enough for 10 lifetimes. If you did it right. And of course if you're lucky. A lot of everything in life with finances is a lot of it comes down to luck, right? You can buy Tesla, all those people who got Bitcoin when they first came out. Remember those things? That got it at like $5. Some stuff of this comes down to luck. Last thing, do you ever advise clients to stay away from buying?
The only time I'll advise someone to stay away from buying is if it truly does not make financial sense, in my opinion, right?
Yeah.
So when we look at the budget and we uncover a lot of debt in certain places, whether it's credit cards, student loans, all these different things going on, right?
Yeah.
And all of a sudden they're like, hey, Paul, I want to buy a $500,000 place, but they can't even afford their current situation.
Yeah.
It would just be a conversation of, are you sure you want to do this and do you understand the ramifications, right? So it's not saying, hey, absolutely don't do this. We will strongly recommend not to do it. But as I told you before, Matt, if a client wants to do something, they're going to do it, whether we tell them or not, right? I mean, we can only help them identify the positives and negatives with their decision. Right. We just want them to make the best educated decision they can. So I would say the only time I'm actually telling someone, hey, it's maybe not in your best interest, is when we uncover just a lot of debt, bad debt, and we say, hey, listen, does this really make sense right now? Yeah.
And that's exactly why we had Paul come on here. And this is a big thing for any client that's ever worked with me. I always say, ultimately at the end of the day, I'll tell you my thoughts, my opinions on it, but you guys are the boss. I work for you. So it's up to you guys to decide on, what you want to do with your cash. And we brought Paul on here. And Paul, where can people find you?
So our website's westpointcap.com. That's the best way.
Yeah, and we brought Paul on here to be able to kind of be somebody, if you guys ever need some more help on, what's the best use of my money and, is this the right time or is this the right thing to buy $1 million plus place, etc. To have somebody else to talk to that doesn't have any skin in the game. There's no commissions to be made, right? This is just somebody who can tell you what's best use with your money. So thanks for listening to Laricy Live.